Hi, I'm Skylar Winan with Regan Capital. Today we're going to explore the U.S. Bloomberg Aggregate Index, the largest bond index that a lot of folks follow in the world. We can find this on Bloomberg at WBIX, which stands for World Bond Indices. You can see the indices over here to the left, some other important factors, and this is year to date. You have yield, you have duration, you have year-to-date returns, you have one-day return. This was down 94 basis points yesterday, down 66 bips for the year. Let's click on the AGG. The AGG currently has about 13,000 individual bonds underlying it at about $26.5 trillion. This is a market-weighted index, so the largest outstanding issuances out there are the largest portions of the index. We can see over here to the right, the top 6 components of the AGG are Fannie and Ginnie 2 and 2.5% coupon mortgage bonds. Let's go back to OAS, option adjusted spread, duration of about 6.25 years. The AGG still has a really, really long duration, basically post 08-09 through ZIRP, through a lot of money being put into the system, durations extended. And durations got even longer post-COVID. Why is that? Well, a lot of bonds were issued at really low coupons. Okay, the average coupon on the AGG is about 3.1 today. Maturity is about 8.5 years. Current price is about $91. Something like 70% of all outstanding United States debt was issued post-COVID. Okay, let's go back over here to components. When we look at the top 6 components, very low coupon paying mortgage bonds. Why is that? Well, if we go to FNCL Mortgage Go and we look at the outstanding mortgage universe, this is just Fannie Mae. You could see Fannie 2 and 2.5 are the top 2 components. $1.5 trillion, $1.1 trillion outstanding. Okay, let's look at Fannie 2s. What is that? These are mortgages that are about 2 years old. The underlying borrowers are paying a 2.94% coupon. Okay, at origination, they had about a 70 LTV or 30% down payment. Today, through home price appreciation, some amortization, their LTV is down to about 65. These were issued at par. Okay, they're currently trading at 79. And when they were issued at par, the market thought that these borrowers were going to prepay at a rate of about 25% per year. Okay, meaning these were about a 3-year bond. But what's happened with interest rates and mortgage rates having been elevated up towards almost 7% now, prepayments are way down and prepayment expectations are way down versus where they were 2 to 3 years ago. So this bond is extended from a 3-year bond on a duration basis, about a 3.25-year average life, to a 9 to 10-year duration / average life. We could say that this bond is almost fully extended. You know, maybe you could go to a 3 CPR and it could extend from an 8.7-year to a 10-year bond, but prepayments can't get much lower than that. Just via death, divorce, job relocation, natural moving, etc., we've basically hit the bottom of the barrel in terms of prepayments. That said, prepayments could go back up to, let's say, 10 to 15 if rates drop precipitously. But let's go back to the AGG. Again, this bond's currently trading at $79 for a drop in price of about 21 bucks, and you're only getting a 2% coupon, getting paid out monthly, 2% annualized coupon. So the AGG is really extended, has a long duration still. But back to the story that I'm trying to get at is that the AGG is a market-weighted index. In fixed income, generally, the best you can hope for is to get par back, okay? And what you're investing in is a tremendous amount of debt that was issued post-COVID at low coupons and very long maturities, where the likelihood of actually getting refinanced or paid out of that debt any quicker than you would hope to be isn't really there. So that's a short and sweet explanation of the AGG and where we sit today. Thank you for your time.